Howdy traders, Mark Heworth here for Flipside Traders, and today we want to talk about the market as it's hitting all-time highs. In the short term, where may it go? Will it go up? Will it go down? At the same time, why is it so high? And does that present us with any concerns? So, without further ado, let's get into it and jump right into the charts first. So we'll go to our charts here. The key thing we're looking at the ES futures, the E-mini futures as a proxy for the S&P 500 cash index. And as normal, right, we always look at the trend, and we'll look at the trend in a number of different ways. First of all, let's look at our moving averages, right? We have the great stack still. Our 200 is below our 50, below our 21, below the 8. So this is showing, excellent strength. At the same point in time, our momentum above zero, a little bit on the downside here, but kind of normal, kind of ebbs and flows, but nothing to really cause any concern in the long term. And finally, we have this, this channel, which is just, moving up at almost an exponential type level. And the key thing is the market is like anything else, right? When you run hard and fast, straight up at some point in time, you may need a rest. And the question is where that rest may happen. So one of the things to look at is that within this channel, if we look over here on the 4-hour chart, and what we can see is that we've pulled back and we're right here now at this pivot point around 32.59. So one of the things we can do is you can kind of see already the market opened a little bit, and we have a potential, just to keep going. We could bounce right off this line. However, given that this is also options expiration, we've been going, full throttle for the past couple of weeks. I have a tendency, or there is a tendency for the market to kind of pull back a little bit. So if this 32.59 level does not hold, it wouldn't surprise me to see us go back and retest the top of value from last week around 32.45. That would be my first checkpoint. And ultimately, if the market decides it really wants to pull back and digest some of its gains, I'd come back over here to the daily chart and come back to value at 32.25. So again, nothing for your long-term portfolios to be concerned about. If you're looking at more short-term, these are areas and where I'd look at to potentially buy on dips, on bounces at that 32.45 and that 32.25 level. So let's take a look now about why the market is growing and how debt is contributing to that. So let's get out of these screen draws here and let's go back to the PowerPoint situation. And we'll go full screen here, make it easy for everyone to see. And the first thing is we have to realize is that we have very accommodating, Fed/central bank policy. Right, you can see that we had the rate cut here on September the 18th. We dropped another 1/4 point. And the market kind of kicked up and with movement sideways is consolidating those gains. And then we had the initial repo crisis. And, check out my other video on the Flipside website. I'll go ahead and put it in the notes about that repo crisis and how it may portend for things we need to watch for in the future. But obviously, when the Fed is injecting, billions of dollars a day, $75–80 billion a day, it gave the market pause. And it gave the market pause, and actually it pulled back a little bit. But once the Fed kind of announced that it was going to maintain this accommodation to the tune all the way through until the end of the year, and then at the end of this year, all the way through the first quarter, you can see that this injection of dollars has just really, fueled the market forward. So, dropping $350 billion to the bottom line is more than ample opportunity to, or ample fuel, I should say, to move the market higher. And right now there's no sign of that abating. So for the moment, it's definitely, the market is going to have its fits and turns. But if we have this accommodating central bank dollars coming in, then I would consider that it would still move higher. But the question is, what does this mean for us potentially, in the long run? And so let's kind of explore this debt thing a little bit further. And so, debt as general, it's not necessarily an evil word, right? It means that, but when we spend, we're pulling, what we spend from the present, our future selves, into the present. And so all our future consumption is bringing forward in time. and that lets us consume more now, but you have to repay it, right? And then someone must pay less in the future, and you have to pay less in the future because now you have to pay down the debt, so you don't have as much money in your pocket to make that happen. But if you use debt properly, you can fuel it for managed growth, right? As long as you can have enough dollars in your coffer to pay that eventual, repayment on the debt cycle. All right, but that is not as what's happening today, right? We are exceeding our ability, to repay as we start, moving our debt levels higher and higher. Like right now, we're at the $1 trillion mark. We're 125% of, GDP, and that debt, you say, well, that's not my debt, it's not my credit card debt, but it is your debt because it's ultimately underwritten by you, the taxpayer, right? If from the repo perspective, we talked about it. It's all the, basically it's the big five banks, Wells, Citibank, Chase, what those guys are doing, again, with their credit derivatives. They're federally insured, so if they go under, that's us. Basically, we're talking about corporate debt. We'll talk about that more. That's the shareholder. You will end up paying that or feel that loss. And the overall consumer, depending on what happens on, with inflation, as it starts to move up, your buying power becomes less. So this is something that is critical to you, the everyday, John Q. public. And it's something you need to look at if we don't manage it properly. The key thing is, and the reason why we've had such a great run is that, we've been fueling this debt cycle. We've had QE 1, 2, and 3. We're potentially now in QE 4 if you take a look at this repo situation that we're in. And we definitely are looking to postpone it. It's human nature and it's financial nature. And this is true for both borrowers and lenders. So this is not going to come to a screeching imminent halt in the crash. But at some point in time, it's going to reach its limitations, and gravity is going to pull it back. So we need to take a look at it because right now we are not, should we say, managing our debt in a responsible manner. And we talked about it because it is growing faster in our ability to repay. If you think about it, right, our estimated debt is up to, on a global scale, on the global stage, is up to $255 trillion by the year end. That's a 4.8% increase. Our GDP here in the U.S. is, basically hovering around 2 to 2.2. For 2020, it's scheduled to be about 1.8%. And most of the world, Europe's kind of in recession. China is kind of an anomaly, in that 5% GDP growth. But even, China's numbers are somewhat inflated and also, may not exactly be true. And so the world itself with its debt doesn't have the ability to repay it. And we're not growing our productivity fast enough in order to make that happen. And so that's something that's concerning. It's just the way it is right now. That is where human nature is going to. The other part is, we talked about, all that growth, but let's look at corporate debt growth. Corporate debt growth is climbing at an exponential rate here. And, we're up close to that $10 trillion mark. And the key thing is why is it happening that way? Well, that's because, as you know, from a bond perspective, and you look at your pension funds that are looking to, basically, pay out their employees, over time, are looking for yield. And they're looking for yield in kind of the riskier portions of the stock market. And that is in, corporate bonds. Well, what happens is that once there's a lot of, should we say, competition for these corporate bonds, the covenants, i.e. the restrictions on what you can buy and how you can buy and what collateral needs to be put up becomes lower and lower, because right now the corporations are basically looking at these bond issuers and saying, whoever gives us the lowest covenants, that's who we're going to give our business to. And so if you don't have very strict covenants and therefore don't have collateral backing these things up, it means that, the only collateral you have is goodwill. And as long as we have low interest rates, potentially they keep servicing that debt. So if we do kind of, hit a stumble in the economy and inflation goes up and therefore interest rates goes up and it makes it harder to repay that debt, then you start getting defaults, and defaults can end up then, triggering kind of a re-rating of those bonds and moving them down from triple B. And the key thing is over 50% of this corporate debt is triple B. And most mutual funds and these bond funds, they have requirements where they have to have, triple B or higher in their portfolios. And if a bond gets rated lower than that, they have to liquidate it. They have to sell it because they can no longer hold it based upon their regulations and what the regulations are as far as what they can hold, right? Their restrictions. And so now all of a sudden you get a run on triple B bonds, and that could really be devastating overall for the general economy. And you take a look at it and you think about things, and really it's about the credit cycle we're in and what could happen and what could not could happen. So we know that there could potentially be a trigger somewhere down the line, right? We talked about the Fed policy and how debt helps us. We've talked, in our other videos in here around, the CDO derivative crisis, what could happen there on the repo side, or potentially high yield bonds. Any one or a combination of those can trigger liquidity scramble, right? And that can then, spread across the whole financial market and trigger a broader debt crisis. Well, if that happens, then you have a lending drought, and then you have rising defaults, and that'll force banks to reduce lending, and then you don't have stable growth, and you can't finance growth going out any further, and that lower growth will turn into negative growth and unfortunately enter a recession. Well, what happens when a company gets in recession? Profits aren't coming in, they reduce costs, and reduce costs mostly by cutting spending around employers. So you have layoffs, you try to look more efficiently, so you go to automation, and that leads to a lack of employment income, and that deprives the economy of its main principal engine, right? Which is the consumer, right? If the consumer, which represents 60% of our GDP, doesn't have money to buy goods, then our economy is going to start to falter. Well, if our economy starts to falter, then there's going to be an outcry to our government, and they're going to ask them to enact policies to cushion that blow. What we've seen in the past, from the year 2000 and 2007, even going back to the recession of, in the 1930s, is that ends up being, too little, too late, and all that ends up doing is increasing our debt and prolonging the recession. So that said, is this doomsday? Not right now, right? We still have some abilities to manage things if we start to take these things head on. So, from an investment standpoint, you're looking at your IRAs, is it something that we must be concerned about? Yeah, we got to be vigilant about it, but we're not there yet, right? We just showed you the market, and we'll take a look at it again of how strong it is. But if you look at the credit cycle, the underlying data of what's happening, it shows that it's very, very strong, and there isn't reason then to just go to a straight cash position. So let's take a look at a couple things right here on this top graph. This is from the Chicago Fed, and this is the National Financial Conditions Index. And as you can see here, is that these gray areas represent recession. And so as long as we stay below these levels, and we're very much below these levels, let me give you a little pointer here. Right, as long as we stay below this line, and right now we don't even have an upward sloping line even approaching this, is that there's a very high probability, at least in the next quarter, as long as the Fed keeps funding those repos out, as they said, through March, that we should see, I'll say, choppy growth, in the first quarter at the very least. In addition to that, we talked about corporate bonds. We talked about their spread and what that looks like against treasuries, and obviously when those spreads begin to widen, then that also can trigger that type of a recessionary liquidity crisis. And as you can see here, we're definitely below that level. We're actually moving downward a little bit as overall bond rates are going up and corporate rates are moving down. So we got a decent spread, and so again we're in pretty good shape from the credit cycle, and that's then of course reflected back here in the ES, and you can see that in the S&P 500 it's there's not any impending technical signals where we're seeing a moving average cross, that we're seeing price below any of these moving averages that would indicate anything more than a moderate pullback that we already talked about to this 32.25 or this 32.59 level. In addition, if we take a look at the VIX, which is kind of the fear gauge, right? And so let's explain that just a little bit more. The VIX is actually looking at the cost of buying options used to hedge your portfolio. And usually they're very far out of the money options that people are purchasing. And you can see here that that cost is very low. So the lower the VIX is, the lower the cost. So therefore, the lower the premium to hedge your portfolio. And right now we're in this, very much this daily, channel. And you can see that we're kind of hitting this low point. And this low point may say, we may bounce around, we may bounce off it, which may help us indicate to get to that pullback we talked before, to that 32.45 level. But overall, we're not breaking out of the channel, which would indicate, something more impending as far as, okay, let's really begin to move our, a cash to a more cash position in any of our long-term investment funds. So there you have it, right? Held you for a good 15 minutes. Hopefully we were able to captivate your attention at that point in time. Right now we're riding things. We're looking for a buy the dip opportunity, and we'll wait and see what the market does, right? This isn't a forecast. This is just a monitoring piece. All right. Thanks, everyone. Have a great weekend. Catch you on the flip side.